What we are going through tonight are these 3 chapters, and if you look closely, these are fundamental understanding of futures. So we'll talk about derivatives. This is also an instrument for risk management, right? Derivatives. Okay. So most of you have some understanding of derivatives, right? So anyone would like to say that if I have Japanese yen futures, is this an asset or a liability? Japanese yen is the spot, right? But I have Japanese yen futures. So I am what we call long on Japanese yen futures.
Depends on which way the
Move? Yeah, but then again, why, if I say that, well, buy Japanese yen, I bought the Japanese yen, okay? Is this an asset or liability?
buy it as an asset.
Okay. So if you buy something, it's an asset, right? But do you think that Japanese yen, when you buy, it will go up, but nothing else? Is there any asset in this world where you can say that you buy it and it's going to go up? Yes, there is one asset. Diamonds are forever, right? Isn't it? One of the reasons the diamonds are forever is that it is rising, continuously will rise, right? Because of monopoly. When the competition will enter, you will have diamond fluctuating, just like gold, right? Platinum. But if you have an asset, that means asset will have return and risk components. There has to be a risk, right? Only asset that is supposedly risk-free is treasury bill, right? Isn't it? Some people even will not say that it is risk-free. Okay? Now, so if you have Japanese yen, you think that you bought it, therefore it's an asset. You own it, right? Same thing about Japanese yen futures. You go for it. It's an obligation that you have entertained yourself. If it can give you high return or it can give you big loss, isn't it? Okay. So derivatives derives its value from fundamentals. That's why it's called derivative, right? So Japanese yen is spot is there, and you say it's a futures on Japanese yen, therefore you say it's a derivatives, right? Okay. Now, you have mortgages. From your perspective, you borrowed money, you signed on a dotted line and gave it to the bank, right? It's a note. So, bank owns it. So, it's an asset for the bank? No. Is it an asset for the bank? Your liability, but bank's asset, right? Okay. Then bank can do this, that they can gather together all the mortgages of various sizes, right? And then sell it as mortgage-backed securities. So MBS, mortgage-backed securities, is it a derivative or a spot? It's derivative. It derives its value from the mortgages, which is your houses, right? Okay. So, doesn't have to be called futures. Derivatives can be called in different ways. Same way, if you have an asset and you would like to have a derivative that only entails the right, then there is another kind of derivative known as options. So, we have covered like futures, options. We'll go much into details, but you can see the derivatives means you can create on something fundamental, and that will be derivative. Okay. And the other thing is the swap, another derivative. It's a long-term derivatives. Okay. It is also on futures. So, what you can do is that you can create derivative from any asset. You can be very creative, and that is why these futures, options and swap classes are linked to risk management, financial engineering. You can engineering different kinds of asset, derive different kinds of assets from some primary assets. Okay. Okay. So, can the exotics are something very fanciful, and financial engineers do that. Lots of things that they can do. And when in 1987, the biggest crash after the great crash, depression, where 20% fall in market, and we were blamed, Chicago was blamed for their crash initially. They say that, well, we have created something in here called S&P 500 futures. S&P 500, Standard & Poor 500, big 500 companies in New York Stock Exchange. What they say that because of the creation of futures, we have created the downfall of S&P 500. Okay? So, we thought that, well, that will be the end of derivatives, and then again derivatives thrived, right? Then came 2007. Again, guess what? Who was blamed for the crash? Okay, another derivative, right? More importantly, there is another fancy thing called credit default swap, right? They say that created the problem. So, that has, then you thought that, well, that is the end of derivatives. Okay? Think again. You guys are going to go out there, create more and more derivatives, because you are trying to maximize the value of the firm. Remember that. Risk drives value. So, if you are trying to maximize the value of the firm, you minimize the risk of the firm. And without the derivatives, you are handicapped. You cannot go forward to manage the risk. So, all these derivatives, you have just scratched the surface. There will be other things coming up. So, if you go out there without good knowledge of derivatives, you cannot proceed further in finance. Okay? So, there will be threats that, like, this is the end of derivatives, there will be regulations and so forth, but then again there will be more derivatives. Be confident about that. So, can you tell me just one single reason why derivatives exist? It lists there here, but what is the most important reason that derivatives exist?
To help eliminate risk.
Yeah.
Or limit risk.
Yeah. Help limit risk, right? Because risk drives value. To maximize the value, you have to minimize the risk. In other words, Derivatives exist to hedge your assets. What kind of assets? It could be commodities, it could be currencies, it could be financials, right? So if you are a portfolio manager, you have a portfolio that mirrors S&P 500, then you see that, well, there is a threat of inflation out there, right? Threat of economy going down, so you can do one of the two things. You can get out of that portfolio you have, right? Sell it before it goes down. Or you say, well, this is the nature of the beast. Whatever you do in your life, the career you choose in your life, or investment that you do in your life has some risk, right? That doesn't mean that you will abandon that. You will try to minimize the risk, right? So instead of selling that portfolio, what can you do? You can sell the derivatives. Are you with me on this point? Right? Why do you have to abandon the ship? If you go and if you want to open up a savings and loan association, a bank, S&L bank, versus a commercial bank, you say, no, you know, S&L bank is more risky, it is mortgage oriented and so forth. I should get out of this. That way, in any business, you can find that, well, because it has a risk, I cannot deal with that. But always ask, okay, there is a risk, risk drives value. Only thing that I have to do is find or engineer a new way of minimizing the risk. Are you convinced the derivatives have to be there? Because main reason is risk management. Are you convinced though? Okay, now the second part. These people are called hedgers. People who take derivatives in order to protect themselves. Hedgers, right? Protect them. There are long hedges, there are short hedges. Long hedges are those who takes the long position. In fact, they take upon themselves an obligation to buy the underlying asset. So let's go back to our oil futures that I was referring to earlier. If you take an oil futures, long oil futures, what you have agreed to do is buy the oil, whether it's a WTI or any other grade, you say that I have obligated myself to buy the asset. But the futures that you are holding, you do not say, I bought the futures. That's a wrong word. That's why you say you take a long position. Okay? But when we talk as a matter of speaking, we say, okay, I bought 4 futures or or 3 shorts and so forth. So to be semantically correct, you say that, well, I took a long position. Because you are not buying anything. You are just binding yourself to buy something. Okay? Now, when I told you that, well, you may have a bad night, right? Then you can get back with me and then I can give you certain options, right? So everything in life have embedded options. You may exercise it or you may let it expire. So when we, let me bring you back to Finance 521 or your basic managerial finance. You know, you did capital budgeting, meaning that is long term. Capital means long term. So let's say you want to build a building and you are exploring whether this is worth it, right? So you do NPV analysis, right? Cost, and then the present value of the future cash flows, expected future cash flows. Then some people will say, if the NPV comes out to be negative, they will say, okay, let's abandon this. Some people say this is a wrong thing to do. You haven't taken the embedded options in here. Let me give you an example. Corning was doing an excellent job, right? They became the leader in their own field. All those cups and glasses that we grew up with it. When I say we, I mean I grew up with it. And they were the state of the art and so forth. They were the leaders, simple. But they found out that, well, when you get, it has a life cycle. Any kind of industry has a life cycle, right? It goes up, and at some point it stabilizes, and then it decays, right? So in that industry, you can be the leader of a dying industry. Soon you will die. So Corning was facing that kind of activities. That is, well, yeah, our saturation point. So they thought about this, that there must be another way where we can employ our talent. And they looked at new economy, they found out the technology needs a huge bandwidth. And to create a fiber optic, fiber means glass, optic means light. It needs glass. And we are experts on glass. So why don't we apply that option to go in that trajectory? Now they became leader. They're the number one seller of fiber optic. So you have to look. You do not abandon ships. Your mindset should have derivatives in your mind. I know under the standard analysis, this is no, NPV is negative. But have you thought about real options? Right? So, in your career too, is this the dead end? Or have you thought about, under the new circumstances, what is my real options here? Creative mind will find that out, okay? So, the other ones that I mentioned are there, but also remember that the hedgers and the risk management are the main reasons. But then you say, if I am managing the risk, somebody has to take the risk. No? If you and I agree that I will buy from you and you will sell to me, then isn't it I'm trying to give you the risk and you are also accepting the risk? In order to accept the risk, there has to be a profit for you. Right? Okay. So the speculators can come in. So hedgers, speculators. Now, derivatives are traded in exchanges, and then some derivatives are over the counter. Which do you think outweighs the other? OTC or exchange traded? OTC. Why is that, Ella?
I guess because it's over the counter, so people, it's easier for people to get access to that.
Yeah. uh, it is unrestricted, right? That's what you're saying, right? An exchange trade is restricted. Everywhere, whenever you have OTC, it is the big players who dominate the market. Big players have the big demands and not necessarily the standard demands. So, what do you think swaps are? OTC or exchange traded? OTC, mainly OTC. And, when OTC happens, then, the smaller shops come up and say, okay, we'll do this for you, okay? All right, now let me go through. These are not challenging aspects, right, for you. And since 2008 is a landmark, when we get burned, we get really in a panic mode, right? So emergency medicine and regular medicine, there are difference, right? So if you apply the emergency medicine during regular time, it's not a good idea, is it? So emergency happened, so we had some regulations. In 1929, emergency happened, we had some regulation, but that lasted 60 years. In an efficient market, this should not last more than a decade, right? Because something needs to be taken care of. But you cannot live on an emergency mode all the time. It's draining. Okay, you can see the size of OTC versus exchange traded. It's huge. It's in $1 trillion. Yeah, it's in $1 trillion marks, right? All of them. Okay. Lehman bankruptcy, you heard of it, right? Why do you think they went bankrupt? Do not bring the politics into it, but is the derivatives the cause? Yeah. MBS, right? And MBS, they were holding lots of it, and somebody was also insuring it, like AIG and others, right? Then they say, well, their insurance is not good, so they have to go. This summarizes what we do. We hedge risk. Speculators take a view, right, and make money, perhaps. Another thing is arbitrageurs. They come into the picture because we are developed country. A developed country is close to being efficient, right? And efficiency in financial market is not necessarily input-output. It is about wasting of information. So we know that in a developed country, people will not waste information. If they have it, they will act on it, right? And so the arbitrageurs look at those different prices, futures price versus the spot price. If what we had been saying tonight, the derivatives derives its value from fundamentals, then you say, okay, there may be an opportunity between the fundamental and the derivatives, right? They can be out of equilibrium. And if they are, then we can make risk less profit, and that is what arbitrageurs do. So they're basically smart people. They see whether there is a mispricing. If there is a mispricing, they take advantage of it. So, and we can change the nature of liability, like take the case of this one. I give you two business. One is S&L, and another is pension fund. Pension S&L, it has certain kind of structure. Let me put this here. What is their asset in S&L? You go and get mortgages, right? Isn't it? Okay. So their assets are long-term or short-term? Long-term assets, and their liabilities are short-term, right? So if interest rate rises, their short-term liability rises very quickly, right? Right? Okay. Now take the case of pension fund. Pension fund, every month or every 2 weeks, some amount is deducted to go to your 401k, right? Now, that's premium. This is going to them. So your liabilities, first of all, assets. Their assets are short-term or long-term? They are getting in on a short-term basis, 2 weeks, right? So this is short-term. And their liability is long-term, right? When you retire, you will get insurance, pension. Now, when interest rate rises in this case, is bad for them. When interest rate rises for them, is good for them, right? Isn't it? When interest rate falls, it is good for this, S&L, right? Right here, S&L. And when interest rate falls, it is bad for them, correct? So what they can do is, again, what is the nature of liability in here? Short-term liability and long-term liability here, right? Pension fund can say, in a rising interest scenario, pension fund can say that, well, this is a good business to be in, right? And S&L say that, well, this is a bad business to be in, right? So let us all become pension fund. Or they can do some risk management technique. What is that? They can go into what is called fixed versus floating. It is called interest rate, right? What is happening in here? Who do you think will give fixed and who will give floating? Their assets are fixed, right? So you give what your assets are, right? So this is fixed going this way and this is floating. This is interest rate swap, right? Okay. So are they both protected? During bad times for S&L, what is a bad time? Interest rate up or down? Up, right? They will have higher floating rate coming to them so that they do not become bankrupt. In the bad time for pension fund, when interest rates are low, right? What will they get? They get a fixed rate, right? Which is higher than the floating rate because floating rate is lower. So both of them are protected, right? So what happened to the nature of liability now? The fourth point here, to change the nature of liability. What happened to the liability? Sorry? The nature of liability. Their nature of liability was what? Short term, right? Theirs is long term. Now that this swap happening, what is the nature of liability for S&L? It became long term, right? What is the nature of liability for this guy? Short term, right? So there is the thing they say that without changing the business, without abandoning the business, you can change the nature of the business. Right? So that's financial engineering in work. Okay, again, it's the same stuff, nature of investment. If I have FTSE portfolio, Financial Times Stock Exchange, and then I have S&P 500 portfolio, I see Europe is going to do well, and I see us doing bad. So instead of selling our stocks and buying their stocks, we can say we can go into some kind of an exchange like this. By that, we will change the nature of investments. Give me one example where you change the nature. You can think of any, either as a portfolio manager. Think about a bond portfolio manager. You're holding a bond portfolio, let's say $100 million bond portfolio. You see interest rates are going to rise pretty soon. So you know there is an inverse relationship, right, between the price and the interest rate, right? So you have a $100 million worth of bond. You expect the interest rates to rise. What can you do to stay in the business yet not hurt by it? Do you want to think about this a little bit more and give it to me next week? This is one of the few things that you will give me next week. So please make sure that you're a bond portfolio manager, you have $100 million worth of bonds, you expect the interest rates to rise. What can you do to manage this risk? Clue is you can change the nature of your investments.
Do you sell like a forward contract?
Okay, but nature, you know, there has to be one business here, one business there. Okay, yeah. All right, so how are we doing so far? Charlie?
Good so far.
Yeah, good. The speed is okay? Okay, I don't know Mike. Brad. Okay. So, Brad, what do you think? The speed is okay?
I think so.
Okay. Yeah, okay. Good. So, whatever you see on the syllabus is my wish list. Okay? When you allow me, I'll go and make my wishes come true. Okay. All right. This is a quote for Great Britain pound. Bid and offer. Those of you who have international finance, to you it's a piece of cake. Right? Now, this is the bid, means dealer is saying that they're going to buy at this prices and dealer is saying that they're going to sell at these prices, correct? Okay. So this is the spot, meaning that if you are going to get pound, like currency that you and I exchange, it is at $1.55, $1.5541. So the dealer is willing to buy it at $1.5541, and dealer is going to sell to you at $1.5545, right? Of course, there will have to be bid and ask spread, otherwise they will not make money, right? Now notice there are forwards in here, and then I did not speak of forwards as distinct from futures. I was using as same, right? But forward is in the currency business. It came first and then futures came later. So it's obviously is OTC. OTC comes first and then exchange follows. Okay, we can do that in our group. What do you see in here? Just looking at this, what do you see? The market is telling you the current price. Take the case there because that's more relevant. If they sell to me, that means I can buy at this price. My buying price is that one, right? That's relevant. So can you tell me, just compare these two. What is market telling you looking at future 1 month from now? Pound is expected to go down, correct? If you continue on, what is the verdict of the market? Further you go on, you will see that is coming alive, that is depreciation is going to come, right? So here is, of course, you can understand that, well, just looking at the two things at the same time, both the spot and the derivatives, you can tell about the value of an asset, right? You can give the value of your asset. Now, 1 month forward, 3 month forward, and 6 month forward, they are all different. Why? Because there is a time element, right? You see that is going to happen. Now, can it happen that, well, they are all same? It can, but that is not the norm, right? We can create a forward curve out of this. Okay? I can put 1 month forward rate, then 2 months, 3 months, 6 months, and I can plot that, right? Now, keep this in mind. The one that I just said. That is, I can put Great Britain pounds forward, okay, and it can say this is the 1 month, this is the second month, and this is the third month. I can do that way and list the prices, right? They're all different forwards. I will introduce to you, probably at the end of next class, what we call contango and backwardation. Very rich theories. The theory of backwardation was given by Keynes. You may have heard of his name. He became very famous when we were threatened. You know, at that in 1917, Soviet Union came into existence, right? The communists took over, and in 1929 we had the biggest crash. So this was the battle of two different systems, and then everybody thought that we are going to turn red at that point in time, right? So Keynes came up with the rescue, and what Roosevelt did, the New Deal, based on Keynesian economics, which means the government must do something. In order to save free market, you have to intervene. A non-free market is required for a free market. That's Keynesian economics. So he gave the theory of backwardation. Another guy, not a guy, a Nobel person, a Nobel laureate, Hicks, he came up with contango. So if you give two economists a chance to espouse theories, what do you think will happen next? There must be another one, right? 2 plus 1. And that's our efficient market hypothesis. So the contango and backwardation that I am going to talk about is not this. In practice, they use contango and backwardation as situation like this, right? 1 month forward, 2 month forward, and 3 month. Okay, so keep that in mind. I will put them in contrast to each other. And that theory, if you learn it well, you can use it in your favor for your investments. And that's why, remember in your report, that has got the biggest weight, 25 points. Remember, hedging, that theory will come up. So that I wanted to make this point right in here. Okay, so forward price is the same as futures price, except that it is customized. So if I want to do Great Britain pound, right, we saw that. If I go to CME, I will get one contract that has a size of 62,500 pounds. If I need a million, then I have to divide a million with 62,500. And what is that? Dan, can you, or Mike, whoever, give me the number. I need 1 million pounds. How many contracts that I have to go for if the contract size is 62,500? Do you understand my question though? I want to hedge 1 million pound and I would like to go long futures. I go to CME and they offer me one contract, each has a size of 62,500 pounds. So how many contracts do I have to get? 16, right? If I need 1,015,000, then do I have exact contract available from CME? No. So I go into fraction. You may be on the conservative side and say, okay, I'll take the more contracts than less. But if you are in a forward market and you need 1,015,000 pounds, you'll get it because that is customized and futures is standardized, right? Futures has another big component. You know, in order to make the exchanges risk-free, you have to have certain kind of control in the system, right? Especially in futures, or you tell me, in forward and in futures, players are, where do you see small players, in forward market or in futures markets? Futures market, right? So when you are a small player, what is the chance of reneging the contract? High or low? Let's say there is a big player and there is a small player. Where do you have more chances of reneging the contract? Small player, right? Isn't it? Big player, if they renege, what happens? Reputation. It's a huge reputation capital, right? You're out. There will not be any Facebook circulation. In a golf club, immediately it goes, okay, he's a persona non grata. That's it. Nobody is going to do business with you. So in exchange, there has to be some kind of innovations, and their innovation was mark to market. And I'll talk about that to you. That is, in order to make it risk-free, they devised a system called mark to market. Okay, and I'll show you how it works. So, but if you go and check the trading and the risk of trading in futures market versus forward market, they can boast the same. Okay. As I said, party that has agreed to buy is taking a long position, agreed to sell is a short position. So can you tell me about this? I mean, this is a very elementary aspects here, that you have a long forward contract to buy £1 million. Oh, wow. In 6 months at a rate of 1.5532. What are the possible outcomes? Give me initial motivation. Why do you go long?
The exchange rate may fall, and you may be paying more for 1 million in the future.
You're in the right direction, Adam. Fall, exchange rate may fall. Right. Yeah. Okay. So, but what are the, just because you took this long position, right? Do you expect, first of all, you had a fear that it might rise, so you pay more, right? You had the fear. Fear drives you. Risk and fear, there has to be fear. We call this, not only we in finance quantify the risk, right? Beta, sigma, all those things, they all quantify the risk. But at the same time, we also have something called risk aversion, degree of risk aversion. We also quantify that. So when you are fearful, when you are anticipating that, well, pound might go up, so you take a long position. And when you take a long position, will it always validate your fear? That means it has gone up, will go up. Can it go down? It can, right? Now you tell me, if you took the long position, previously you were afraid that it was going to go up. Now that you have hedged yourself, what do you say about yourself? Now you hope that it goes up, right? Fear versus hope. The difference between them is hedging, right? When you run a political election, let's say, fear and hope, you say, how do you transfer the fear into hope? Hedging, right? Think about this, that this is the way we deal with the fear. We hedge ourselves and it turns into hope. Now, what do you hope to happen to this? It is now 1.5532. You hope that it goes to 1.56, right? Will it happen? Will your hope be realized? Maybe, or maybe not. So, Brad, what can happen?
So you're hoping that what you feared would happen actually does happen.
Yeah. Well said.
It's like confirmation bias.
Okay.
So once your fear becomes validated, you hope that your fear is correct.
Okay. What can happen otherwise?
Hope the exchange rate goes down.
Down. Okay. Now, I want you to calculate the profit and loss for me. We'll go for 5 minutes break after this. This is t equals 0. Okay? futures price is there. First, give me the spot. What was the spot price? Do you recall? $1.5541, right? This number here, 1.5532, right? What are the likely outcomes? How many? How many classes of outcomes? You can say infinite outcomes. I don't want that answer. I want an answer that can be operationalized. What are the likely 3 classes of outcomes?
You go up, you go down, or you go to the exact amount.
Stay the same. Okay. So if when you took a long position, you hope that it goes up, right? So let's say at S90, it goes up to $55. What did you say, Adam? 6, right? So calculate the profit for me. Himal, will you be able to help us? Okay, just by unit, by pound first.
0.8804.
Okay, so 0.8804, right? Per pound, correct? How did you get this number?
Took the long position, the spot minus the.
Okay, so you say 1.5600 minus 1.5532, right? And that is this answer. Now, what Himal asked me that what kind of answer you want? Do you want per unit basis or per contract basis? The contract is 62,500, right? So if it is one contract, then how much profit you will make? This is for 1 pound. Oh, did I do it wrong? Is this wrong? Okay, what is the number?
0.0068.
Okay. Okay. So can you tell me, this is for 1 pound you make this, correct? For one contract, how do I get the contract profit? What do I do?
Multiply by a million.
No, for contract, right? And what? 420 per contract, right? Now, for 1 million pound, how many contracts did you buy? 16. So to protect 1 million pound, you bought 16 contracts. So how many you will make? 6800. Sorry to write this low. I'm so sorry. 6,800, right? Okay, I'll make sure it goes up. What is the other one? First of all, why did you subtract the spot from futures? I understand that this I will ask you to memorize in my class, I usually ask that you have very short memory, okay? But within that short memory, you have to memorize the profit to long is spot price at maturity minus the futures price. But before even I give you the formula, I have to show you the logic behind it. What is the logic behind it? Why do you say that this is the profit? This futures gives you the obligation to buy at this price, right? If you did not have this, you would have bought it at this price, 1.5600, which is S sub 90, correct? So naturally, this forward futures gives you this amount of profit, right? So that's why we say that profit to long, first you know why the formula is S 90 minus F sub 0, because it gives you the opportunity to buy at a lower price. What is the other outcome?
Futures for the spot price at 90 is lower.
Okay, so if I make it 5.5, so now you see that you are obligated to buy at 1.5532, right? If you were not in this futures contract, then you would be buying at 155, right? Because of the futures, you are paying an extra 0.0032, correct? So that's your loss. So in that case, you say 1 point, you have to change this, right? So you say futures 1.5532 minus, no. Profit to long is 1.5500 minus 1.5532, correct? What is the difference?
$0.0032 per pound.
So this is for 1 unit of pound, right? For one contract, what do? You change this one, right? 0.0032. So what is the per contract profit? This is a negative number, right? Yeah, so you have to say negative. So negative what again?
200.
Even? 200. And then for contract? 32. So you have 200 per contract, and multiplied by 16 is 3200 per what? 1 million pound, right? Okay, so let's take a 5 minutes break and we go through the rest of the other. Okay, welcome back. We just saw the profit to long, right? So I want to take those numbers. Let's say this is 1.5532. That's the futures price. And we tried one with 1.56, another with 1.55. It is not drawn to scale, okay? Those are the two numbers we tried, correct? So this one, the difference between 1.56 and 1.5532, what was it, Adam? 0068. So this is 0.0068 and the profit was 0.0068, correct? So if you take these 2 points, you draw like that. On the other hand, this was 0.0032 and the loss was 0.0032, again the same stuff. Two arms are equal and then you go to this, right? So you now have a 45-degree line. So you see the profit to long, you call this profit to long. You can get unbounded profit, you can get unbounded loss, right? You might say that, well, I do not have unbounded loss. It's bounded here, right? It's bounded. No, it's a huge loss. It's practically, when you in terms of money, it's unbounded loss. And if you look at the profit to short, it should be exactly opposite, right? So profit to short must be this one. So I want you to get comfortable with these curves because I will need this curve to explain to you about options. Okay? All right. Now, I would like you to go through some of the PowerPoints. If you have questions, ask me next time. But I have gone through the main aspects of it. Now, this is the short and this is the long. And, where am I? And these are the places where exchange traded futures are there. Now, what I want you to do, there are questions in here, I would like you to solve them. Okay? So it says that the spot price of gold is $1,400. 1 year forward price, 1 year forward price. It made it very simple. Not even 3 months, 6 months, or 9 months. 1 year is 1,500, and interest rate annual is 5%. Is there any arbitrage opportunity? So in order to do that, you need the understanding that futures is a derivative. It derives its value from fundamental. So in a way, you are looking at futures as equal to 1 plus R. So you look at this equation, right? Futures is deriving its value from fundamentals. Deriving its value, right? So you have a spot price there, you have interest rate there, figure out. And then they will tell you whether the left-hand side is greater than right-hand side or whether they are equal. If they are equal, it is fairly valued, no arbitrage opportunity. If right-hand side, which is futures, is greater than the left-hand side, is there an arbitrage opportunity? Is there any arbitrage opportunity? You say yes, right? One side is more expensive than the other side, right? What do? You buy the less expensive, sell the more expensive. So that is the thing that you need to do, these problems here. So is there any arbitrage opportunity? You have to tell us why. Okay. Then they have helped you here and you say yes or no. And then the oil, the same situation. Spot price is $95. What is it now? Adam, what is it now? Oil price, you think? Is it 48? Huh? Okay. Yeah. Yeah. So how much down you see?
0.91.
Yeah.
91 cents.
Yeah. Okay. And then you have the storage cost and interest cost. Remember, this factor that you see here is cost of carry. So interest rate, storage costs, they're all part of cost of carry. So we see it this way. How many ways you can have oil in future? How many ways? You can go long futures, one way. Another way is? No. You see, when there are two markets we are linking here today. One is the futures market, another is the spot market, right? So you said there are two alternatives. One is the spot market alternative, another is the futures market alternative. If you go long for futures, you know you have that, you can get oil in future, correct? Correct? So that's the futures market alternative. Another is the spot market alternative. What does that mean? You buy the oil now, right, and carry it to the future. So there are two ways to get the same oil in future, right? Through the futures market or through the spot market. Make sense? I mean, that's what we are linking. And both must cost the same. If they do not, then there will be arbitrage, right? Okay. Now let's talk about option. And that's why I said that we need this part. You saw profit to long is like that, right? What option does is cuts this and limits the loss. In the case when it was $1.55, right? You wish that you didn't have that long futures. You wished only, but you're obligated, right? Options gives you the right, not the obligation to buy. So when it is below, like this 155, you say, okay, I'm not going to exercise this option. Okay? So it cuts the loss right in here. This is defined as long call. This is long call option. Okay? So this is profit to long call. Same way, profit to short. Let's say you have short position in futures. You are afraid the price is going to go down. You are a seller. You are afraid the price is going to go down, but you took a short position. So now your fear turns into hope. You hope that it goes down. Instead of going down, it goes up. Then you have a loss, right? What is that loss? Right in here. So you will, can you cut this down? Yes. This is known as profit to, anybody? No. Long put. Both are long. Right? Profit to long put. Okay. American options have more freedom. European options, less freedom. So you can exercise option anytime in American options. So I want to also at this point show you a scenario. These are the exercise price. You're talking about a call option, okay? If you have got the right to buy at this versus buy at this, which one do you think you will pay more? If you want to have the right to buy at 820 versus 900, which one will you pay more? 820, lower price, correct? So you can see as your exercise price goes up, your call option price goes down. Okay. Now I go row wise. Previously I went column wise. Row wise, this is bid and offer for 2013 June. I go to December. When our expiration is not 1 month from now, it's 3 months from now, do you want to pay more for that call option or less for that call option? Let's say you bought, in this case you will say buy an option. You do not say long option, I took a long position. I wrote long call, this is fine too, but here you buy an option, buy a right is bought. So if you buy an option with the same exercise price but with more expiration day, what will that give you? Will your hope be realized if you have further time?
More likely.
More likely. Therefore, pay more. Okay. So that is what will happen to the put side? The reverse for expiration, right? But what about the strike? Again the same, right? This is the put options. You love the higher price to sell, which is the column. I ask the same question to you. Will you have more price to pay for a strike of 820 versus 900? If you are trying to buy a put option, will you be willing to pay more for 900 versus 820? This is a put option. And the definition of put option is right to sell. So if you have a right to sell at 820 versus 900, which is more profitable for you? 900. Therefore, you can pay more. An expiration, if you go to the expiration, then again your things will realize. So it gives more price, correct? Okay. And so which one will you take between forward and futures and options? This is something that as we prepare our individual reports, we'll say. But one thing you need to remember that you can produce forwards and futures in option market. Okay, so just give you an example. You saw, let's say, I have a long futures here, right? Can I produce this from options market? Let's say this is your long call, right? Isn't it? Correct? Okay. You add to this a short put. You get something like this. Okay? You can also deal with this what we call payoff. If you take a long payoff, this is called long call payoff. What is the difference between long call profit and long call payoff? Long call payoff is benefit only. Long call profit is benefit minus cost. Because option you have to buy, that's why there is a cost below, right? So instead of taking long call profit, we are taking long call payoff. Instead of taking short put profit, we take short payoff. So this is short and together they make long call. Are you comfortable with this one? I am just giving an illustration to you that you can produce futures in an option market. So option market is more powerful market. So if you want to choose between options and futures, those who understand risk management much more, they would prefer options. And there are a lot of other elements and attributes that option market has. Okay? These are the types of traders we went through. Excuse me. Please go through these examples. Okay? Excuse me. Well, so far we showed you that, well, option market and futures market can be used to hedge. It can be used to speculate too. And those are the dangers that you face. If you speculate, then obviously there is a dangerous element that's come into the picture. So my example, usually I mention that to my students, that all of us have kitchen knife, right? It's a tool. Why do we have that? To cut things, right? To make us prepare food. But you can use the knife to kill somebody. So is it the knife's fault or is it the user's fault? Yeah. So don't blame the derivatives. So dangers come from the users, and especially what we call unethical use, right? So if I have the capability of insuring you to, let's say, $100 million, and I sell insurance for $500 million, why do I do that? Because I get lots of premium, isn't it? Do you see the point? So there is a moral hazard component that plague the users. Let's go ahead and do it. We get the premiums, right? So please, there is an example that book gives you. You look at that. Okay, now, if you look at the various financial institutions, you have a bank, which is most regulated. Then from bank, we went into mutual fund, which is less restricted. And then from mutual funds to hedge funds, which are further relaxed, right? So in hedge funds, we can use these derivatives. What do you think? If you use derivatives and you get the return, which will give you the most return out of these three different classes of institutions? Hedge funds, right? People who drive all those fancy cars, follow them, it's very likely they are in hedge funds. Very likely. Okay? So if you know your derivatives well, your prospect of getting into hedge funds are very high. Okay? Different types of hedge funds we have. Will you be okay to handle this? I mean, yourself? There are some things I said, please do it. Will you be okay? If you're not okay, please get into discussion board. Okay? This is where I'm having difficulty, please help. And I will see others helping each other, and that will give you points. This is the beauty of this system. If you help one another, I will help you. Okay? All right. So nice. I know you are not clear on options, and I know that, okay? But there will be a lot of future lectures on it. Where did it go? Mechanics. First of all, why do you think that, well, convergence of futures to a spot? Let's say this is the spot price, this is the futures price, right? Our example was opposite, right? So they're not the same. Why will this be the same at expiration?
The closer you get to it in real time, the closer the future price will come to the spot.
Right, right. Any other explanation?
Market faces itself. Too much, opportunity probably.
I mean, they're all in the right direction, but they will be the same when they become the same. Right? What does future mean? That, well, in 90 days from now, you will be buying this at that price, correct? 90 days from now, correct? As you go to 89 days, 88 days, and to 0 days, what does the future converge to at 0 day? The present, the spot. So they must be the same. The price 90 days from now, and then these features evolving will have to be the same, because it says that assume tomorrow it is going to expire. On March 18th, you will be buying at that price. So spot price and that price must be the same. So as you approach the spot, as spot and futures become the same, their prices must be same. So that's one. Once you settle that, you talk about margins. That futures market has what we call mark to market. To have a mark to market, you have to have margins. There is initial margin, there is maintenance margin. Initial margin versus the maintenance margin. Why do you think we should have margins? We do not buy anything. Do we buy anything with futures? We got into an agreement, but we don't buy anything, right? Why still we have to give some money?
I'm sure that if you're gonna pay, like it's kind of like insurance to the other person that like you're helping.
Safety deposit, correct? Yeah. So for when, as you saw, long side gets money when prices rise, right? So if prices falls, then long side will be losing money, isn't it? if the money, losing money piles up, at some point it becomes very risky. So they want some deposit, refundable deposit. If it is in your favor, you will get this money back. If you have a long position and it is going up consistently, your margin is sitting there yielding a risk-free rate. They will give you that interest rate too. So you have margin. Initial margin is placed at higher level, and then it says, okay, if you have a long position and your prices fall, you start to lose money. If you lose money, let's say by $10, you should not be asked to fill it up to full. So they give you a breathing space between maintenance and initial. But once you touch the initial margin, they do not say, let's say initial margin is 6,000. You reach the maintenance margin of 4,500. They will not say, okay, can you please fill it up to 4,500 again? No. They will say, go back and fill it up to 6,000. I gave you breathing space. Now you have utilized all of it. Now you became really risky. So bring it up to initial. We'll give you an example of this pretty soon. Okay, this is the scenario. This person has a long position in 2 December gold futures, 2 of them. One of them has 6,000, therefore 2 of them should have 12,000. In maintenance margin is 4,500, therefore 2 of them is 9,000, right? Okay. So look at this scenario here. You start at 1450 per contract. Next day it is 1441. You have a long side. So you lost 1800, right? Why 1800? You lost only 900, correct? You have to multiply by 100 because the contract size is 100. Okay? So if the difference between these two is 9, but it is 100 is the contract size, so therefore 900. So 9 plus 9 is 1800. So you lost that. So initially you placed a margin of 12,000. From 12,000 it is now 10,200, right? Again this goes down. Remember, a long position loses money if it goes down. So 1438.30. So again, how much is the difference? You do not go back to 1450. You already marked the market to 1441. That's the mark to market innovation. You do not go back to, you say, okay, I should subtract it from 1450. No, no, no. You have to subtract it from 1441, right? What is the difference? Can anybody help? It's like $2.70, right? Meaning 270. Multiply 100, 270 times 2, 540. Are you with me? Okay. So you go, and then it goes down to the last one. Okay. Now what I want you to see here is, up until this point, you're okay. You are not going to get a margin call. Why? Your maintenance margin was 4,500. Times 2 is 9,000. You are above 9,000. Therefore, you do not get a call. Look at the next one. You're below maintenance, right? So at this point in time, what will you be asked to do? What will you be asked to do? To make it go to 9,000 or make it go to 12,000? 12,000, right? So how much do you need to pay? You have to wire transfer the money. You do not say check is in the mail. You even can get a call in the dead in the morning. They're pretty tough. So 4020 should be there immediately. If you add 4020 with 7980, what is it? 12,000, yeah. So you continue. So this is called mark-to-market mechanism, how margin works, right? Be prepared for questions like that. At what level will you get a call? At what price will you get a call? Do you follow what I'm saying? Yeah. I will skip those positions. Now, this is one of the ways that you explain, and yours is much more fancy. FactSet, you go to FactSet, you get everything from there. So here they're telling you that how you're going to read. June 2013, its open is this much, high, low, prior to settle, last trade, change and volume. Volume means what happens in the day, and outstanding contract or open interest are the ones that accumulated ones, contract. Delivery is a very important concept that I would like to go with you. Let's say you have a long position in pork belly, a lot of pork bellies. And you say, well, I'm obligated to buy from you. So I go to Chicago Board of Trade, which is now under CME Group, and I demand from you, give me pork bellies. If everybody goes to Chicago Board of Trade or someplace where they demand the commodities, it is impossible, right? So they have a system in place. They say, instead of doing that, can we cash settle? Do you follow what I'm saying? So if I have a long position and prices go up, right? I know I will get the money from the other guy. Instead of, okay, I'm going to buy it from you at a lower price of futures price, I will not demand that, right? I will say, okay, give me the price difference. After you give me the price difference, I will now go to the spot market and buy it at a higher price, right? Do you follow what I'm saying? Let's take the case of the pound that we had. Let's switch from pork belly to the pound because we had the numbers. Our number was 1.5532 futures price, correct? Price now goes to 1.56. I tell you, who is on the short side, that why don't we cash settle instead of buying the pounds from you at 1.5532, I will say, give me the difference, 1.56 and 1.5532. Then I go to the spot market and I buy the pounds at what price? 1.56, right? You see? 1.56. Now, am I paying more? Futures, when I did the futures, I am guaranteed to buy it at 1.5532. Do I get into 1.5532 effective price? Do I? If I buy it in the spot market at 1.5600, do I still get 1.5532? Samantha, do you see that?
Yeah, because it's like the difference.
Right. You got the difference from that guy already, right? So you say 1.5532 plus the difference he gave you, you buy it at 1.5600, but your effective price is 1.5532. Yeah. So 99% and above trades are done or reversed. And some of them are even, when you go into the trade, before it goes into expiration, people go out by taking a opposite position. answer these two questions on page 19 so that you understand the open interest. Okay. Types of order which you will need when you say profit to exit point and loss exit point. You see, I can buy it at the market, or I can buy it below the market. I think the market price is high, so I say I buy below the market. So I place a limit order right now. I do not wait. Limit order right now. Limit order means below the market. Then you have a stop loss. You say that, well, I can put a stop loss order, meaning that if it goes and hit this, I will be out of the market, so that no more losses incurs for me. And stop limit is sometimes, especially we always buy low and sell high, at least try to do that, right? But those astute investors, they say, well, as long as the difference between the buying and selling is there, they are okay. So they do not want to buy cheap. They want to make sure that the buying price and the selling price, there is a difference, that the selling price is higher than the buying price. So they say, I do not know if I buy at a lower price, let's say 1.55 price, and then pound falls, it doesn't do any good to me, right? I got the inexpensive way, but it makes me losses, right? So rather I would buy it at a price when I think it will go up. That means I will buy it higher than the market. The traditional mindset is buy lower than the market. These people would say, let me buy higher than the market, buy stop. Okay? People who would like to short it, if you want to short something, sell something, you would like to sell it at, no. If you want to sell something, you want to sell it at a higher price, right? They say, no, I am not going to sell it at this price. When I want to short it, this is like 1.55. I am not going to sell it at this price. I will sell it when it reaches 1.54, below the market. Why? Because at that point, it will ensure me that it is going down. Again, their objective is not to buy cheap. Their objective is to get a good investment. An investment means growth. Do I have a growth opportunity, return wise? Market, if it touches this, then that triggers. Fill or kill is another one, and open orders are there. Time of the day for a particular day, and discretionary, which is that basically that this thing. Can you find this for me? I'm not clear about the discretionary. I have done all other things. Discretionary. Find that for me, please. Regulation is done by CFTC, and you must make sure that accounting and tax for derivatives are done so that, do you remember Enron example? Enron debacle? Yeah. You cannot take the futures and derivatives and others in a different subsidiary. It has to be in one. Foreign exchange quotes are the way that we always do, that means price of foreign currency. Please keep that in your mind, price of foreign currency. Okay? So Adam, if you have an answer to that, let me know.
Yeah, discretionary order or market not-out order is traded as a market order, except that execution may be delayed at the broker's discretion in an attempt to get a better price.
Okay. So it is left to the discretion of the broker. Thank you. Okay, now how do you hedge? Let me give you the case of exporter. Exporter will receive some pounds. Will the exporter take a long position or a short position?
Export,
Yeah. Why? Because they have to sell something, right? Okay. So when you have to sell something, go short or sell futures. Even though the terminology is not proper, but in order to have the mnemonic device, sell something, sell futures. Buy something, buy futures. Right? Even though buy futures and sell futures are not correct semantically, right? Okay. So now the importer needs to pay 3 million pound 3 months down the road. What do you think they should do? What are you afraid of? That is the question you are going to ask. You are an importer, you are going to pay 3 million pound. In order to pay 3 million pound, you have to buy 3 million pound. What are you afraid of? Yeah, changing meaning?
so if you're
Meaning-
importing something, you would want to hedge yourself against your domestic currency being devalued against the other country's currency.
Okay. So basically you are saying that, well, that you are afraid that price of pound will go up, right? Okay. So futures locks in the price. Okay. So of course there is a strong reason for hedging. Okay? But arguments are that people will say we are diversified anyway, we do not have to protect ourselves further, and it may increase the risk to hedge, and more importantly, there can be basis risk. They say later on, we'll talk about it. Now, what is basis? You see, when I see the current situation, spot price is 1.5541 and the futures price is 1.5532. So people are saying that in future the price of pound will go down, right? Still I took the long position. I did not buy that. If I believe that pound will go down, why would I hedge? I want to buy something in future and I know it price is going to go down. Why should I hedge? In this case, the case that you are looking at, I should have said, okay, market says it is going to go down. Okay, I will not take the hedge. I will be without hedge, right? But I took the hedge because I did not agree with the market. And market goes up, price goes up, I make the profit from it, right? Now, when I'm taking this hedge, spot price is here and futures price is there. What is the guarantee that in between, this is the expiration time, assume, in between the movement the difference between them will remain the same. What is the guarantee? Do you follow? There is no guarantee, right? So the difference between S and F is known as basis. So the basis risk can be there. It can go in such a way that my hedge will not be able to protect me. Do you follow what I am saying? So that is why we say that there is a basis risk that you have to take care of. And when we talk about hedging, basis risk is a very important feature, and that we will spend time on it. And as I said, in your hedging analysis, this is a very crucial part it plays. So let's look at this asset is S sub 2. What is the gain on futures? You say F2, the later, minus F1. We did S90 minus F sub 0, right? It's the same thing. F2 minus F1. Now, net amount would be S2 minus that, correct? Okay. So, this F2 minus F1 is B2. So, you have now F1 and this B2, which is basis. Those of you who love math, go ahead and show that that's true. Those of you who do not love math, just believe it. Okay? So, the whole idea here is that what I am trying to show you is that basis figures out on your net gain. Basis comes as a factor to your net gain. Do you follow what my stressing point here is? Okay? Okay. So that's for long hedge. Yeah, I can see lots of people are working on it in the mind. How is it true? Yeah. Okay. All right. Then the next one, the short hedge. The price the same, but you take the short position, and short is defined as the first, right? Initial features minus the later features. And then your net gain would be S2 plus this profit to short. Profit to short is F1 minus F2. Then again, when you do that situation, that means S2 and F2 can be together, so which is B2. Again, your net gain can be figured out by just looking at the basis and add to the futures. Okay, so how do you choose a contract to hedge? You know how to hedge, right? If I have to sell something, I go short. If I want to buy something in future, go long, right? Okay, and then I have to be extra careful about the basis risk. Okay, then once you do that, you say, okay, I have British pound. What should I hedge with? Should I take British pound futures? Should I take euro futures? Should I take treasury bill bond futures? What should I take? What is the choice of this asset, right? Answer is you take the direct one. So if it is pound, you take the pound futures, right? Do not take euro futures. Okay. What if I want to hedge an asset that does not have futures? What if that happens? So when Chicago Board of Trade, they were essentially commodity exchange. They introduced treasury bond futures, they did not think that this would be the biggest pit in the world. Why? Because treasury bond is such a thing that can act as a hedge to every commodity. So if you have no futures on its own futures, you say, okay, let's do treasury bond futures. Okay? This is known as cross hedge. Some people even go in the direction that, well, even if you have your own futures, they say, okay, no, let me take the cross hedge, because the cross hedge asset is more liquid. Right? Let's say you have euro to defend. Some people may say, okay, I will take dollar futures. Why? Dollar futures may be more liquid than euro futures. So it depends on you. You are the risk manager. Optimal hedge ratio is, okay, so far I did not even touch this. Okay, you have to have 1 million pound to defend. You say, I will get 16 contract, right? So it is like 1 for 1, 1 pound and 1 pound futures, right? Is this optimal? So people say that actually you can do much more scientific analysis. Instead of saying 1 to 1 or using an ad hoc number, let's say when it comes to fraction, you say it comes to, let's say, 36.15 contract, you took 37 contract. Right? Let us make an error on the side of being conservative rather than aggressive. So you say, no, I'll give you more information. Information comes in the form of standard deviation. Sigma S, S is the spot that you are trying to protect, and F is the futures. So you say, I would like to look at the variation of spot and futures. They will be adjusted by that amount and the correlation between the two. So the book does an example. They are trying to do 2 million gallons of jet fuel. By the way, you know, Southwest example, right? Southwest is a glaring example. They did not do sophisticated risk management. They say, okay, because oil prices are so fluctuating, let us take oil futures, go long on oil futures. When every other airline were actually teetering on bankruptcy, they were happily flying you to the happy places, right? So did they use this kind of hedges, optimal hedge? Of course they did, but not a very fancy approach. It's simple approach that this is a variation. The variation in the spot market is very high, therefore they did the hedging. So here you see you are trying to get the jet fuel, and correlation between spot and futures is 0.928. So you say your hedge ratio should be 0.78. Okay? Not 1 for 1. Why do you have to overhedge if your data doesn't suggest that? On the other hand, heating oil, you go through that again, the value of the asset and value of the futures, right? And you multiply with this 0.78, you get 37 approximately contract. And there are other ways to calculate optimal hedge ratio, and we essentially the same, but then instead of, we say correlation, this is between spot and futures, these are estimated numbers. Okay. Index futures. I understand one for one, oil and oil futures. But what about I have a portfolio. There are 40 stocks in a portfolio. Shall I hedge each one of them with futures? So you say index, I can say, okay, instead of doing each one of them, I will do an index. This is called occupational hazards. The dust from the chalks going to my throat. Yeah. So what do you think I should do? 40 stock portfolio. I will do for IBM futures, something like that. Or I will say, no, let me take an index which is close to this portfolio. Right? That way you do not do several one of them. But here the very important concept is the beta. You are all aware of beta, but this is the beta of the portfolio, not beta of individual stocks. Okay? So you take the beta of the portfolio and look how they shape that. Please do this example. You might get a question on this. It's very, very important how you adjust by the beta. So this is the formula you are going to use. Beta. So it is adjusted by beta, right? Higher the portfolio beta, higher will be the contracts that you will be taking, right? So you have a value of portfolio 5 million, beta of the portfolio is 1.5 and S&P futures price is 1,000. So you figure out these questions. Please do this question. What happens if portfolio goes down to 0.75? What if portfolio beta goes up to 2? How many contracts? That you have to figure out, right? So if you change, beta changes, what are the contracts thing? You have to figure out. Now, that gives you a clue. If you're a risk manager, I know you're going to protect the portfolio. Can you change the portfolio beta? Can you do that? You see how intricately risk management and investments are related, right? As a portfolio manager, you put the portfolio together. You learned, if you have taken the investment course, you have learned that, well, security selection, right? When you do the security selection in such a way that portfolio beta can go down. Therefore, your requirement for hedging will go down. It doesn't eliminate, but you do not have to take so many contracts. This is a very important point though, the relationship between investments and risk management. Because beta comes into play here, and you see as beta goes down and up, contract size varies, right? So once you understand that, you say, okay, I can deal with the beta in investment section when I do the security selection, right? Or allocation. Okay. There are various ways to hedge. I mean, you can stack them, you can roll them, and these are the ways that you can. Let's say I would like to hedge myself for 1 year. I can take 1 year futures, or I can take 6 months futures and roll over to another 6 months, right? I can do 3 months, roll over to 6 months, 9 and 12, right? Which is better? Usually, longer the distance it covers, illiquid the contract is. Nearby contracts are much more liquid. So, there are techniques, and this is one of the techniques, very simple technique though, that's where you do the thing. And then the liquidity issue is very, very crucial one. Go through this metallurgist, okay? Go through this corporations debacle, long-term contracts. All right. What I will do and what you will do. Next time, I need for you to do the homework from fact set. Okay? So please, those of you who are having difficulty, share that in discussion board. Okay? And help each other, and if you cannot help each other, then I will step in. Okay. Second thing, if everything fails, I will have a special session at 5 o'clock in that lab downstairs, okay? So come down if you need help, all right? Do the problems of the PowerPoint and then read the next 3 chapters that are coming up so that you become aware of it, okay? And the last but not the least, what is that thing? Last but not the least, you need to come up with an asset of your choice, primary asset of your choice. I just want to know whether you are going to deal with cotton. There are 3 classes, broad classes, commodity, currency, and financials. Which one do you want to do? And then you will figure out whether you are going to hedge it with futures or options or swaps. Okay? So that is very important. And I will form the group in the next class, and I need inputs. Otherwise, you may end up with all the quant people, or you may end up with all the quality experts. Okay? All right. Thank you.